For starters, I will have each of the speakers give a 30-minute introduction, and then we will dive into the questions. So, Yi, do you want to start?
Yes, sure. Hello, everyone. My name is Yi Wang, investment principal at SAIC Capital. We're the corporate venture arm of SAIC Motor, which is one of the largest automotive group in the world. And my previous experience include management consulting at McKinsey and tech startups in the Silicon Valley. I'm very happy to be here today.
Thank you so much. Deepak, do you want to follow?
Yes, good afternoon, everyone, or good evening. My name is Deepak Gupta. I am the general partner at Rock Ventures. I just am currently leaving or transitioning out of Blue Bear Ventures. We are a Berkeley-focused fund. We actually started doing a lot of stuff in deep tech. So I do the climate side of the fund itself. I've had 10 years of both startup experience and about 15 years of venture capital experience. 10 years of startup experience. I went through 2 IPOs myself. And then in the past 15 years, I've done both corporate ventures, venture debt, and started a fund. I've been around long enough that I remember the 1.0 climate tech, and now we're at the 2.0. So I'd love to talk about that. Thank you, Adrian.
Yeah, we'll keep that in mind. So Kevin, go ahead.
My name is Kevin Chow. I'm a corporate partner at Canal Gates. Canal Gates is a global law firm co-founded by Bill Gates' father, Bill Gates Sr. I'm currently based in Silicon Valley. We represent technology startups at every stage of their life cycles and in various industries, fintech, healthcare tech, climate tech, AI, blockchain, DAO, education, and e-commerce, just to name a few. I work with many extremely talented international clients, many from Asia, some from Brazil and Mexico. Thank you for having me here to join the discussion, but anything I say does not constitute legal advice or create any attorney-client privilege.
Thank you, Kevin. So for starters, let's set the scene. Since 1990, the Intergovernmental Panel for Climate Change has talked about climate change. It has been around with hard data that says we are rapidly ramping up to 400 parts per million of CO2 in the atmosphere. And what does this mean? It means that the Earth is warming up very fast and is causing a lot of weather effects in humanity. With our current behaviors and business models, we're on track to go beyond the 2 degrees Celsius of global warming, and that's not viable for Earth survival by the humankind. So it is a big and a hard problem that we need to tackle together. It needs a lot of hard tech and soft tech solutions in order to create action. And a reason why we have seen in the news major trends coming up, like the Inflation Reduction Act and the US and the European New Deal. That's public money that is starting to incentivize private money into action. So we're going to talk about the private side of things and how private money is creating that traction and change. So Yi, let's start with you. I would like to hear from you, what is the one micro trend that you are following that drives your investing decisions into climate beyond the main drivers previously mentioned?
Yes, Adriana. Yeah, I want to first emphasize on the big trend that you already identified. It's very clear that we are seeing a very strong tailwind from the regulatory side and on the tackling climate change problems. And if we look at it one level deeper, the underlying driver of the policies is actually the fact that climate change has now become a more imminent problem versus 20 years ago. If we don't take any actions now, we're going to see the impact from the climate change in the next 50 years. It's going to be very scary and very expensive consequence for human beings. So that's why we are seeing this fundamental shift in how governments, corporations, and consumers perceive climate change. And this is going to continue to further hail this overall trend forward. So that is absolutely the core reason of everything. And apart from that, what I noticed is one very big driver is actually the enabling technology readiness and also the price parity being reached. For example, electric vehicle and battery tech, these technology have advanced dramatically in the past 10 years. And now we finally have electric vehicles on the road that can deliver as good or even better user experiences for consumers. So these create true motivations for consumers to think about buying. And price-wise, they're also becoming more competitive if we look at it on a total cost of ownership basis. So these are economic reasons are always the very important driver. And another example is renewable energy. Electricity from the solar power has dropped dramatically since 2009. And now the solar power and wind power are among the cheapest options for businesses. So now the renewable energy have become truly attractive for business because they not only addresses their ESG requirement, but more importantly, it saves these business a lot of money in their operational cost. So these economic drivers are more fundamental to this overall trend. And I can see that even though it will take a quite long journey for the entire energy transition to happen due to the existing infrastructure and all of these capex that has been deployed already. But definitely if businesses are considering replace the existing systems or expand, they definitely want to review the renewable options because they are becoming more economically attractive also.
Thank you. Yeah, really great point. Let's ask a little bit of a different question to Kevin. We know that the IRA has placed constraints on startups abroad that are bringing new technologies to the market, especially for those that are kind of like developing technologies in other places, but the IRA is nationalizing a lot of the technologies. Kevin, in this current geopolitical environment, how do you go evaluating and supporting climate startups from legal angle so they can thrive in this economy? And do you have a specific example of that?
Yeah, sure. I would say from the founder's perspective, building a solid legal foundation against current and future elements of weather is very critical. So for early tech startup, this could mean healthy corporate governance, IP portfolio protection, regulatory compliance, data privacy and security, and preventive HR employment practice. So climate tech startups can also face some unique legal challenges, environmental, energy law, as well as global initiatives on climate change. But despite the challenges, as Yi mentioned earlier, there are some new opportunities. For example, the Inflation Reduction Act has nearly $370 billion for climate measures. So that legislation is the largest investment in climate change mitigation adaptation in US history. So climate tech startups should take advantage of this opportunity to the extent they can. Next, I want to spend a bit of time on a trendy legal topic, which is CFIUS. Almost all inbound investments nowadays by foreign investors, especially Chinese investors, need to consider CFIUS. For startups that want to receive funding from non-US investors, one threshold inquiry from both the startup side and the investor side would be if the proposed investment or financing would trigger a CFIUS filing. So for those of you who don't know what CFIUS is, CFIUS stands for Committee on Foreign Investment into the United States. By way of background, CFIUS originated from the Defense Production Act of 1950. But in 2018, the Foreign Investment Risk Review Modernization Act was signed into the law. So this is also known as a FIRMA. So before FIRMA, CFIUS had jurisdiction to review mergers, acquisitions, and takeovers only where a foreign person was acquiring or could acquire control of a US business, whether through equity or contract. FIRMA was introduced to address loopholes where foreign persons can learn to replicate sensitive US-based technologies without triggering CFIUS review. For example, a minority interest in a joint venture. So now with FIRMA coming to play, CFIUS has jurisdiction to review certain foreign non-controlling investment in US businesses if they're related to, for example, critical technologies, critical infrastructure, or maintenance or collection of sensitive personal data of US citizens that could threaten national security. I just want to note that U.S. business here is very broadly defined as any entity, U.S. or foreign registered, engaged in interstate commerce in the U.S. So for covered investments, any non-controlling investment that affords foreign investor access to material non-public technical information or membership or observer seat on the board. It doesn't have to be a director seat on the board, or any involvement in the making of that U.S. business. So if you do a CFIUS analysis and decided to file filing, and sometimes either you initiate it as a startup council or the investors council, they may file a joint declaration with CFIUS, and that will trigger the review of it. Sometimes it takes 30, 45 days, and if the CFIUS determine there's sensitive new technology or infrastructure involved, they will continue the review and ask for additional information. Based on our experience, CFIUS review is very intrusive. So they will ask about the US business. They will also ask for the proposed investor and even prior rounds of financing investors information, their name, address, who's the ultimate beneficial owner. So if, say, at the end of the review process, and the CFIUS determines that a covered transaction presents a threat to a national security, it has the authority to do several things. One of the several things, for example, suspend the transaction. You cannot move forward. You cannot close the transaction. Or if the transaction has already closed, they can order the company to do some mitigation measures to resolve the national security concern.
That's really interesting. A lot of facts and angles that you have to consider in terms of new technologies and the investment community from abroad. So I was wondering, Deepak, since you mentioned at the beginning in your introduction that climate and clean tech 1.0 happened like about 15 years ago, what is different this time? And how do you make it happen for real this time?
Yeah, absolutely, Adriana. I think with CFIUS, one thing I do want to add, there are ways around it. And for investors, if it's a financial return, there's a way to get around it in terms of tech and especially venture capital, but it has to be declared. It's only for financial returns, not for any technology. And it's a very sharp definition on that. But let's talk about this. Let's talk about even back in 1980s. I don't know how old everyone's here, but if you remember back in those days, there was something called the ozone layer, and people were worried about the ozone layer getting bigger and bigger and bigger. And that was due to all the freon that was going out from the coolants and refrigerators, you name it. And somehow the world came together and the ozone layer actually got smaller and smaller. I'm not saying it's completely there, but in the 1990s, things did turn around. I'm very bullish with climate tech in terms of the world and what we're doing right now. And I'm very hopeful that we can turn this around, right? So regardless of what Exxon and all the old companies are doing right now, let's talk about 1.0 and 2.0. Really quick, 1.0 was started because of the solar revolution, and there were tons of companies in solar. The thing that happened with 1.0, the government was not as involved. There were a couple of things that was going on, but it was very high capex. And the VCs back then were trying to figure out how to make money. It was very hard for them to get the return, and there was a bust. The 2.0 is going to be very different. I think the government incentives are there, and there's a lot of stuff going on with 2.0. But I think, as Yi had mentioned, there's more of a world, a do or die kind of situation with climate tech. And we really have to look at these technologies now with the 2.0 to really understand how fast can we get them to the market? What incentives is the government providing? And second thing is, how are we going to make money? At the end of the day, all the investors on this panel or in the world who are investing in climate tech need to figure out what that business model is and how fast it's going to bring the money back to them. Simple as that. For all the entrepreneurs, especially doing battery technology and all that stuff, you have to focus on that business model.
No, thank you for the insights for around the past. But let's talk a little bit about the current economy. We know that the VCs are not investing as fast as they were 2 years ago or 3 years ago. They are expecting lower valuations. And we also have general VCs that expect investments in climate to be a little bit smaller returns because they're infrastructural in nature or they're commodity in nature. So we had bank runs that just happened like a couple of months ago. Silicon Valley Bank being one of the banks that really supported climate and hard tech investments. So Deepak, let's talk a little bit about those bank runs and what are your thoughts on the gap that they left, especially for climate tech startups, and knowing that like now the normal banks are there, but they may not be as open to take the high risk of hard tech.
Yeah, unfortunately, this is a very perilous time in terms of banking and what's going on. But let's take a step back with interest rates. As you know, in the past year, interest rates are going high. But the job market in the US is very tight, thank God, because that's what's keeping the economy together. But from a venture capital standpoint and LPs, because all of us are raising money from LPs, we have to figure out if they put money in treasuries and they can get 5%, 5.5% tax-free, why would they invest in venture capital? So we have to have a higher bar for returns and trying to understand that. Second thing is, if you're an entrepreneur and you're a Series B, C, and D, the valuations are a lot lower. So when the valuations are a lot lower because of public markets, and we can discuss this later, it's very hard to raise money because some of the preferred stocks and the common stocks would not be worth much in that they were previously. So if you're a new entrepreneur raising money, this is a great time as a seed investor, Series A investor to raise money. All those VCs that were doing late stage are running to early stage, and they're trying to figure out where to put the money. Climate tech is very hot. That's why we're doing this panel, because there's a lot of money, not just from government, but a lot of VCs trying to figure out, okay, how do I differentiate from everybody else and really go after early stage investing? So from an early stage investing, I think the valuations are right on par where they should be, and we could talk about valuations later. But when coming back to the banking, the VC model is strong and really going after and finding these great in climate tech. We will figure out banks, but they might not be the regional banks. They might not be Silicon Valley Bank, but you will have JP Morgan and other bigger banks coming in and taking their places. So yes, it's very dangerous because the interest rates are high and these bankings are dying, but venture capital and early stage investing is very strong. And I think that's where we need to keep our focus.
Thank you for those insights, Deepak. Do you have a specific framework when evaluating climate investments with today's economy in mind? Has your mindset shifted based on the current economic?
Yeah, I'd like to first resonate on Deepak's point. Climate tech was one of the hottest segment and one of the most resilient segment in the past 2 years. So we did witness a downturn in the public capital market, right? And that very quickly influenced the private equity investment, starting from later stage and little by little pushed towards early stage as well. And in the meantime, since 2020, some of the very big funds raised high amount of money, right? So actually, the dry powder on the capital market was at historic high. So where did this money go? All this money are ready to be deployed, but in a relatively cold VC weather. I have to say a lot of those money went to climate tech, largely thanks to these regulatory tailwind, infrastructure bill, IRA, and which made climate tech one of the most resilient and a still hot area in VC investment in the past 2 years. And we did see a bit of the gap from the company's valuation and their level of commercialization. And it was very hard for investors to make rational decisions. And however, we see things are changing too. Like this year, the fundraising activities have slowed down, and all the volume of climate tech investment has dropped by 30% in the last quarter this year compared to the same period last year. So it's going to be very hard for climate tech to still stay at a peak level in 2021 and in 2022. So it's all these change in the supply and demand on the capital market does influence a lot how climate tech startups raise, how easily they can raise money and their valuation. And for us as investors, as a fund, we want to set up a framework that is as rational and objective as possible. That is to say, we have to still stay with the business fundamentals. We want to see the technology differentiation. It needs to have the product market fit that has true customers ready to pay, and it needs to show a clear path towards commercializations. So all these elements are very important for us to evaluate. No matter the overall investment environment is at a good time or bad time. So sticking with those principles are very important.
Thank you. So let's switch our views into more of the technology and the trends that we're seeing today. We know there are 7 verticals of investing into climate tech, and these 7 are energy, food and land, transportation, the built environment, carbon, the climate management and risk, and industrial applications and decarbonization. Do you have a specific focus on a vertical? Does your fund invest in that specific thesis? And how do you consider software solutions in climate?
Yeah, so we are an automotive company, so we're naturally interested in the mobility and transportation technologies and application. And for example, electric vehicle, battery, EV charging. And apart from that, we have become more and more interested in microgrid or distributed energy management, because when you imagine half of the world vehicle become electric, the power grid is probably not going to be able to support that. So this is an area, especially for US, we see this trend that power grid goes distributed and going to local and micro form of energy storage. And now we have the vehicle as the end device and infrastructure. We need to think about the energy sources. The energy sources need to be renewable for the entire ecosystem to make sense. That's why we're also very interested in renewable energy like solar and hydrogen, specifically green hydrogen, that is the hydrogen produced from water electrolysis. Yeah, so these are the key areas we would focus on. Our thesis is more around invest and support innovations that favors electrification and the overall energy transition. Yeah, you mentioned software. It's true that in climate tech, a lot of the technologies are highly related to hardware. But we do see software involvement in several different formats. For example, it can be the product offering itself. For example, EV fleet management. So the software is the company that sell in a SaaS model. And secondly, software can be a very important part in an entire full solution. For example, energy storage management. You have the battery control system as the hardware piece, and you have on top of it the software that does the smart management, tracking, and automation. So that's most often the case we see. And lastly, very interesting, we see the AI and machine learning more and more involved in the R&D process of these climate tech, like a new battery electrode material discovery, or new solar material discovery and the tuning. A lot of companies are using AI now in their R&D. So even if the customer buy a product and nothing to do with software, but software actually played a very important role during the R&D process. So in our due diligence, we want to also evaluate the company's software capability for that purpose.
That's a really good point. Like, yeah, it is enabling technologies, and I'm wondering now, how are you seeing ChatGPT transforming those industries? talk a little bit about the introduction of something new. How have you seen it impacting new startups or being integrated into new startups?
A few words. Just very recently heard someone saying that the generative AI is gonna change many sectors, including autonomous driving. So it was a little bit overwhelming to hear that, but after some processing, I'm open to that. But the technology is evolving so fast. Question mark, but open to that.
I second what you said. I think generative AI is going to make an incredible impact in self-driving cars and stuff. But overall, software, the way it's being applied, it's really going to revolutionize everything about climate tech. Right now, there are two areas. I mean, we in South Dakota produce enough wind just in the state of South Dakota, supply all the electricity in the US just by wind, all right? The problem we're having is how do we move that wind energy, put it back to the grid? So that's one of the problems. Same thing with solar. We have enough energy in Southern California. We could supply all the energy in US just by solar, right? So it's incredible amount of energy that we can produce by renewables and what's going on. What I'm really excited about, and maybe something the years, I'm at Berkeley, so there's a lot of innovation going on in Berkeley. There's something that you guys should look at in terms of Berkeley AI research coming into the AI. It's called BAIR, B-A-I-R. You can Google that. But how that's impacting climate tech, because there's a lot of stuff with hardware and AI research that's coming together that we haven't even thought of right now in terms of not just ChatGPT, but software, but even on the hardware side. How are these robots actually learning and improving on what they're capable of doing? And which I'd love to jump into examples later when we have time. But it's like, this is where AI and climate can really impact a lot of us and really build something for the future.
Awesome. Thank you for that. So let's talk a little bit about the technologies that you are super excited about in climate tech.
I think the Berkeley research, a lot of stuff's going on there. And right now, there's a lot of stuff going on towards carbon capture. That's a very big moment in Berkeley in terms of research and what's going on. But I think a lot of the hardware we haven't really talked about, even the air quality. I mean, if you go to China and other countries, there's already knockoffs of air quality. But to get the air quality to a certain standard and to be universal, that's still the golden thing that people are going after.
And what is overinvested? What do you think is just already getting too much money and it shouldn't?
So in my view, there's a lot of investments still going into solar in terms of technology. I'm trying to make them more efficient. But I think to Yi's point, we should look at more of trying to figure out how to move that energy once it's produced to storage or movement of that. That's something that I think we need more money and more research on.
Got it. Thank you. So let's go a little bit more into the legal components of things and bring Kevin back into the conversation. So, Kevin, early startups maybe make a lot of mistakes in the legal realms because of lack of knowledge or because people are just really good at the team or the technology, but need the technical support. So can you let us know a little bit more about what are the common mistakes that startups go through in those early stages, and especially recommendations for those to watch out?
Yeah, sure. In terms of recommendation, I think I mentioned earlier, I highly recommend building a solid legal foundation. I think that's very, very important, which will probably require you to retain an experienced lawyer as early as entity formation, not depending on ChatGPT as of now. You don't need the most expensive one, but I think you need someone with relevant experience. So as part of that legal foundation, I think corporate governance is the pillar of that foundation. So I think for advice, I can share some real life experiences on several common mistakes that we have seen from our clients that used online services or maybe even CPA to prepare the formation setup. I think one of the very common ones they will miss is the 83B election. I think that's very important for founders to do at the beginning when they receive the shares subject to vesting. So what the 83B election does is to have founders to pay taxes on the fair market value of the stock at the time of grant instead of when it vests. So that will have a potential long impact on the founders' taxes. So in terms of foreign founders, so we have a lot of foreign founders and they choose not to do the 83B election because they said, I'm not subject to tax. But we advise them sometimes if you are coming to the United States or you are in the process of getting a green card, it's better for you to do the election. There's a deadline, which is 30 days when you receive the stock. So that's one. And then another issue we noticed, common issue was the 49A valuation in connection with the stock option issuance to employees and consultants. So at very early stage, you can rely on some board consent language to get away with a 49A valuation. But once you reach a price round, you need to do a 49A valuation before you get the common stock price before you issue stock options to employees or consultants. So that's another one. And then there's also common mistakes for picking the wrong entity to start with, LLC versus C corporation, Delaware versus other jurisdictions. But if you consult experienced lawyer, they will give you the right advice.
Can we talk a little bit more about that one in particular? So like, what are the difference between going Delaware versus others?
Yeah, sure. I'll be very brief. So Delaware has a very established legal system. They have a special court to deal with corporate disputes. So they have very, very good precedent. U.S. is a case law country, so giving a lot of visibility and predictions on what's going to happen to your case based on the precedents will be very helpful. So Delaware also is extremely efficient. So during pandemic, for example, if you do a merger acquisition or you want to get Delaware corporation filed, you can still do that. I think they still maintain the 2-hour, even 1-hour turnaround service versus California. During pandemic, they will suspend the services. So the expedited service, if you want to get a corporation merged or charter filed with California, you have to wait 7 to 10 business days or even longer. And then from the VC perspective, the VC wants to invest in a corporation as opposed to LLC. So that's another reminder to early stage founders that there's a VC tax requirement behind VC's decision. Two more I want to point out, I think is pretty useful, is the employee misclassification. So when the company first started, they want to cut costs, they want to treat everyone as consultant as opposed to employees. Then California law is very strict about misclassification, misclassifying employee as consultant. And then one last thing I want to mention about is founders, foreign founders or international student founders who are on maybe H1, maybe on B visa or in the process of getting green card, not having a valid work authorization in the U.S. to hold themselves as a CEO or CFO of a U.S. corporation. So they may have some immigration issues down the road because technically CEO or CFO are employee. So you are not supposed to work in the U.S. without a valid work authorization.
We are getting very close to the end of our conversation. So do each of you want to give us our one last comment about investing in climate tech?
I'll keep it short. For climate tech investment, the long-term trend is clear. The short-term investors, please allow some patience.
I'll go a little bit further, but for founders, I love technology. I think you guys are incredible in terms of technology and what you guys are building, but always keep in mind the business sense of this. Why are we building this and who's the customer? Sometimes we lose sight in terms of technology and how long it'll take.
Nice. Yeah, that's really good. And Kevin, one last thought.
Building a solid legal foundation for your startup venture.
Yeah, get your lawyers. They really support you.